$412. That is what was left in the checking account on the 28th. The mortgage auto draft hits on the 1st. Daycare pulls on the 3rd. And this household earns $250,000 a year. Top 10% in North America. If that picture feels familiar, keep listening, because by the end of this, you will know the exact dollar amount a household at this income actually controls each month. And there is one fixed cost most people at this income have never measured as a single number. It costs more than your car payment every single month, and it is going to show up about halfway through. There is a phrase for what is happening here. Call it phantom income. The gap between what you tell people you earn and the money you actually get to decide what to do with. At $250,000 gross, phantom income is enormous. The mechanism is not spending. It is a stack of automatic deductions and fixed costs. They move your money before you wake up on payday. This is how the math works. Your numbers are yours to run. Start at the top. $250,000 gross, married filing jointly with standard deduction. Federal income tax takes roughly $42,000. State income tax in a median state adds about $12,000. And FICA across two earners pulls another $15,000. That is $69,000 in taxes alone. Nearly 28% of gross income gone before a single paycheck arrives. 28 points of phantom income locked in. You are already down to $181,000. If both spouses max out the 401k, subtract another $46,000. That is 18 more points of phantom income. Health insurance through your employer plan averages about $7,200 a year for a family. That number comes from the Kaiser Family Foundation. Another 3 points. Your take-home just dropped to $128,000. That means every dollar you see in your bank account has already been cut in half by lines you never actively chose. Pause on that for a second. $122,000 left your household before it touched a bank account, and you have not paid a single bill yet. Have you ever stacked all of those lines together in one place? Each one feels manageable alone. Together, they are half your income. It is like watching sand pour through your fingers one grain at a time. The pile is only visible when you weigh what is left. Now, the fixed bills, mortgage payment, including property tax and insurance escrow for this income, in a major metro suburb runs about $28,000 a year. Add typical maintenance. The Harvard Joint Center for Housing Studies puts it at 1 to 2% of home value per year. Housing alone takes roughly $36,000 out of that remaining $128,000. That is another 14 points of phantom income. That is the budget line from the top. $36,000 a year, $3,000 a month. Larger than your car payment. And most households at this income have never added those housing lines into a single total. You are down to $92,000. Divide by 12. About $7,700 a month. For a family of 4. Does that number match what you expected? Or is it already smaller? That $7,700 is not your spending money. It is the starting line. Everything you actually decide to buy comes out of what is left after the next set of costs. And in a moment, I am going to show you what happens to that $7,700. Because by the time the non-negotiable variable costs come through, the share of your gross income you actually control is going to be lower than your effective tax rate. That is not a typo. That is the math. You are the person who looked at the salary on the offer letter and thought, we will finally have breathing room. And then 3 years in, you are checking the account on the 26th, wondering if the auto payment for daycare is going to clear before your next deposit hits. You are not bad with money. You are standing in a river and wondering why your feet are wet. Have you ever had this thought? We make good money. So why does it feel like we are broke? Nobody says that out loud at this income, but almost everyone at this income has felt it. That feeling is not weakness. The JPM Morgan Chase Institute studied 5 million American households. They found that the average family experiences income and expense swings of plus or minus 40% month to month. Your income is steady. Your expenses are not. When your margin is thin, one swing month puts you at 0. That is not a character flaw. That is arithmetic. That is where the money goes before you choose. Now, let me show you where the rest disappears and why $3,800 is the number that explains everything. That $7,700 a month is not discretionary. It is where every variable cost in your life sits. 2 kids in daycare or after school care averages about $1,500 a month nationally, according to the Department of Labor. Car payments, insurance, and gas for 2 vehicles run roughly $1,100. Groceries for a family of 4 at this income level average $900. Utilities, internet, and phone plans take another $400. Does any of that sound optional? Add those up, $3,900 a month. What is left of that $7,700, $3,800 a month for everything else? Every subscription, every copay, every birthday party, every home repair, every holiday gift, every unplanned moment in a family of 4. Here's the number that matters. Your phantom income gap at $250,000 gross now totals 82%. You earn over $20,000 a month, but you only decide what happens to $3,800 of it. Think of it this way. In an 8-hour workday, only the last hour and 26 minutes earn money you actually control. The first 6.5 hours were already spoken for, which is 18% of gross income. Sit down with whoever you split the bills with and run this number together. That gap between what you earn and what you control explains the checking account balance on the 28th. Let me say that again. A $250,000 household, after taxes, retirement, insurance, housing, childcare, cars, and groceries, controls roughly $3,800 a month, 18% of gross income. Your number will be different. It depends on your mortgage rate, your childcare costs, your state. Most people at this income land somewhere between $3,000 and $5,000 a month of actual margin. Run yours tonight. Here's where the title question gets its answer. Why does the account hit zero? Because $3,800 cannot absorb the irregular expenses that define family life. Furnace repair in January, dental crown in March, summer camp deposit in April, holiday spending in December. What month does not have one of these? They happen every year, but they sit outside the monthly rhythm, so they land like emergencies. The Bureau of Labor Statistics tracks families earning $150,000 to $200,000. That group spends roughly $3,100 a month on variable costs. That already presses against the margin before a single unexpected bill arrives. So where exactly is the emergency fund supposed to come from? Now, this math shifts dramatically in a single income household or in a top 5 cost of living city. Different numbers entirely. Most of us were taught that budgeting fixes money problems. Your parents said it. Your first HR orientation said it. Every financial article you have ever read said it. Budget better, save more, track your spending. And honestly, that sounds right. It sounds like the responsible thing to do. Nobody mentioned the 82% that was already gone. Here is what that advice actually looks like in practice. Perfect tracking of that 18% saves you maybe $200 a month. Your housing line alone costs $3,000. That is a 15-to-1 ratio. You are optimizing the small side of the equation. The leverage is not where the advice tells you to look. If you are just now seeing this, you are not late. Most people at this income never run the full number. Here is what to do with this. First, calculate your own phantom income gap. Start at gross household income. Subtract every line that leaves without a decision. Taxes, retirement contributions, insurance premiums, mortgage, childcare, car payments, groceries. The number left is your real monthly margin. Write it down. Second, list your irregular annual expenses. Divide the total by 12. That is your monthly irregular reserve. Move it to a separate account on the first of every month before you spend from it. Third, look at your total housing cost as a percentage of after-tax income. Mortgage, property tax, insurance, maintenance, all of it. If that percentage is above 35% of after-tax, that single line is the largest lever you have. This is the one to look at together. The account does not hit zero because you spend too much. phantom income takes 82% before you get a choice. Now that you know your real monthly margin, a specific question follows. That 401k contribution you set up during your first week on the job, the one pulling over $3,000 a month out of each paycheck, is the split between traditional and Roth actually optimized for the cash flow pressure you just calculated? Because the difference between traditional and Roth depends on your tax rate now versus retirement. That gap is not a rounding error. It is thousands of dollars a year. And that math depends entirely on numbers only,